It's almost uncanny. This past weekend, I read Barron's every week, and they have their big money manager poll that comes out like twice a year. And money managers were the most bearish they've ever been in the survey going back to like 1997. And of course, the market ramped this week. As we're recording this, we just had this deal with the UK where it looks like the Dow's up almost 600 points today. It just seems like the darkest hour is always before the dawn. And it just amazes me that markets ramped this week after negativity was at like some sort of zenith.
Well, it seems like that always happens that way. And, the reality is that these money managers aren't anybody extraordinary. We always say that they're ordinary people trying to do extraordinary things, and they think just like the rest of the investing public.
Well, guys, there's an enormous amount of pressure on the part of advisors like us, to make our clients money, right? We always do our best, to help our clients succeed. But we know that the best way to do it is through diversification, which is now known as de-worsification up until the Mag 7 started to drop. So, a lot of times, if you don't have a strong advisor, you're going to fail because they're going to allow you, to follow your worst instincts and chase performance. And that never works. You can't buy last year's performance.
No, you can't. And I think, right now more than ever, we talk about market timing all the time. It's just too hard to do it, right? I mean, look at this year so far. We went into the year with all this optimism. Everyone's feeling really good. Then we felt really bad because of tariffs and the market sold off and it seemed like it was the end of the world. Now, all of a sudden, we're getting all these trade deal done. We are starting to feel good again. Talk about a manic depressant, but that's really the market and the media, when they talk about this stuff on a daily basis. More than ever right now, this is really where you have to have some sort of discipline when it comes to your money.
Yeah, and it always seems like, too, like initially now when I'm talking to all my clients is that, that everybody always wants to buy like the worst investments. They want to buy that structured product or like right now the hot thing I get calls about is gold. We should own gold. Gold's amazing. It's a great hedge in the portfolio. If you look at gold, it hasn't really done that well over history.
But it's having a great year this year, Chris. So, the momentum money that was chasing NVIDIA is now chasing gold, which is exactly what you shouldn't do. And the hardest thing is to be a value investor, right? Because you want to be a contrarian. And I remember in meetings with money managers and, they'd say, yeah, well, I want to truly be a contrarian, but I won't say something contrarian unless somebody in the room agrees with me. I mean, so it's very difficult to go against the flow. But that's how you truly create wealth, right? You accumulate shares of an asset class while it's not performing, not while it is performing. And that's where true wealth creation comes from. And it's just, it's the pressure on us to keep our clients doing the right thing. It's not easy.
I think we should call some of these investments that investors chase after when markets are down, we should call them mirage investments because they're not real.
No, and it's it's kind of remarkable right now because look, I mean, if you look at the underlying economy, I feel like tariffs have almost clouded the fact that the economy has been in pretty good shape, right? All the hard economic data has actually come in pretty good. Any indication of that the consumer is slowing down spending hasn't happened. Everyone likes to look at like the sentiment of the consumer, right? The sentiment of the consumer is so bad. Well, that doesn't correlate to anything, by the way, because if Americans feel good or bad, they spend money, right? Statistically, they spend more money when they feel bad because that dopamine release. But what they really care about is do they have jobs and are their wages going up? And that really hasn't changed. We saw a strong job number last week and wages continue to go higher as inflation continues to moderate. Like these are very basic economic piece. I'm going to say this is very basic economic data you need to know, and no one's talking about it because tariffs have just clouded everything.
Well, the biggest problem is then you have the economists out there making predictions about things that they're never correct about. So the percentage of economists that now, we're seeing a recession coming, it was over 50%. Of course, once we do know we're in a recession, the market's already bottomed and recovered. So it doesn't do you any good, to listen to what economists think and what their predictions are because they're worse than fortune tellers.
Yeah. They drive their car backwards.
Yeah. Well,
pretty much, Chris.
Yeah. That's the one thing that's not talked about a lot is the stock market is like a very accurate forecasting tool, right? I mean, when we had the tariffs issues come up back in early April, markets repriced like that, right? All of a sudden, we saw almost a 20% drop in the S&P 500. Anyone who exports from China, their stock got crushed. So it got priced in very, very quickly. So now, like a month later, now you hear all the economists changing their projections on the economy a month too late. And meanwhile, we're already working through all these trade agreements. So markets are already way past that. And the market's already been going up, telling you ahead of time that these tariffs are probably going to get negotiated, it's actually a pretty accurate barometer of what's going to happen next. Yet most people don't want to believe it.
Well, I was going to wait for that. I was going to use that strategy where I wait for the market to go up a little bit before I got invested. Unfortunately, it didn't work this time.
Well, you do have the best equation of all time, right? You have extreme negativity, profits of companies are going up, and on top of that, you're getting extra stimulus, right? Oil prices are down, which is a huge tax break. And I suspect at some point here, the Fed's probably going to have to cut interest rates, cave to Donald Trump, because basically the data says inflation's coming down. It's like rocket fuel to get this economy and stock market going even higher.
Yeah, and meanwhile, there's $7 trillion sitting in money market funds. And if you add in short-term treasuries and certificates of deposit, you're probably looking at $9 trillion. I'll tell you what, there's nothing that makes an investor more crazy than seeing your neighbor get rich.
Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products. Whether it's an annuity, mutual fund, brokerage product, we'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review.
All right, it's the tipping point. This is where we pinpoint the pain point having the biggest impact on your wealth right now. And Bob, you came up with the best title this week, Fear and Loathing Today's Economy, Money Mistakes to Avoid. And the bottom line is right now we have a very volatile, uncertain time. And what we find is when you have times like this, investors typically make bad decisions. So I thought we'd talk about the top 4 bad decisions we find people make that are extremely detrimental to their long-term financial game plan. And I think the first one here is going to cash when things are uncertain. Sounds so good, but such a bad idea.
Yeah, I loved it when it was at 5.5%, and then not so much at 5, and now I don't like it. I didn't like it at 4. Now it's at 3.8. I really don't like it. Do you guys see a trend in short-term interest rates, by the way, on money market funds?
And the problem is, right, you pay taxes on that 3% or 4%, whatever you're getting on a money market fund. And inflation has been about 2.5%, 3%. So you're making no money. In the meantime, the market's been ramping again, right? It's turned on a dime. It's starting to go up again. So the question is, well, when do you get back in? Do you wait for a pullback? Is it going to keep going higher? And that's where it gets really complex really quickly. So getting out of the market all of a sudden doesn't seem like a really good idea.
Well, and that is the whole point. You shouldn't be fearful and loathing of the economy. You should be fearful of inflation. Everybody's biggest risk as an investor is how much is their cost of living going to go up. So, Chris, you always like to say, you got to own stocks for the best inflation hedge there is, and you don't have to do any work. You just have to sit and swivel and enjoy the return.
Yeah, well, I think that's the hard part is that people don't see that trade-off, that they just have to do nothing and they'll make money over time.
It's kind of like that guy that goes to church every week and he prays to God to, help him win the lottery. And he goes every week, and finally God calls down and says, Joe, meet me halfway, buy a ticket, right? You can't win the lottery if you don't buy a ticket, and you can't get these stock market returns unless you own them, right? So we're getting wonderful dividends next week, right? They're all being increased. But if you didn't own the stocks, you're not getting the dividends.
That's a great point, Dad. A lot of times I'll run through the performance reports with our clients, especially if they're trying to get out, and I'll show them what their return was without their dividends. And I'll point out you can't get them unless you're in.
Well, it's a great point, right? Regardless if the market goes up or down, you're still getting paid on your investments. And the problem is when you go to cash, you have to be right again, right? Because now you're sitting in cash, your money market fund, you're waiting for the right time for the markets to settle down. And Bob, as you love to say, markets don't settle down, they settle up. And as we're recording this today, markets are up over 500 points as we somehow seal a deal apparently with the UK on tariffs. You just can't predict that stuff ahead of time.
Well, the other thing is, I've never seen so much pessimism on the part of consumers, even though they're still spending. Their confidence is very low. Business confidence is low. But meanwhile, we have record earnings. We have record projected earnings. And it's just that uncertainty and that volatility that comes with it just causes people to, fall into their emotions so quickly.
Well, I think the other problem too is that, so many people right now are just invested in one area of the market. If you look at these recent market pullbacks, it's hitting certain areas of the market harder than others. Like, for example, like international is up for the year, and most people weren't invested in international. So it's like when you have a pullback like that, to most people, it's like, well, cash is the answer because that seems like the safest.
Well, that's the other money mistake you want to avoid, right? Is don't double down on your past strategy, right? Because if you got hammered because all your money was concentrated in the same part of the market, well, don't triple down on that, right? Like, put some money somewhere else. And I think it's one of the points too, is like when you go through these volatile times, it's so much more helpful if you have money in lots of different investments, right? Like to your point, Chris, if you're in international right now, commodities have gone up, real estate went up. Your portfolio really didn't go down that much if you had your money spread out. You don't want to live by the sword, die by the sword. When the market's down and it's volatile and all your money's concentrated, it's so much harder to stay invested.
Dad, I think Ryan's still trying to double down on Russia. I'm not sure.
Well, you take a look at international, right? You're getting a 3% dividend. And as you said, Chris, it's up 13-14% this year. But, when you run to cash, look, there's nothing wrong with having a little bit of cash, but you're getting, a little better than 3%, and there's no upside, and you're paying tax, and you're getting, you're losing money to inflation. So, you look at the equity market, and you're able to get an invest with a dividend with a chance of making an additional 5 to 10% every year. So it's kind of a no-brainer if you think about it long term. But I'll tell you the one thing, and this is what, when I go back to Philly next week, they'll have these crash-proof retirement commercials on every minute. And whenever there's volatility, these guys crank up their advertisements so that people can put their money into an annuity, which is the worst thing you could ever possibly do.
Tell us how you really feel, Bob. But no, this is where Wall Street starts to prey on your fears, right? These insurance products that offer you a quote-unquote guarantee. And we know that that's fraught with lots of issues. They have these quote-unquote private investments on Wall Street that are supposed to be less volatile, give you more yield. But we find is the fees are higher, and they're just hiding the volatility because they don't price a lot of these investments on a daily basis. But this is where you have to be really careful, because when you're at your most vulnerable, that's when Wall Street really starts to pitch a lot of these more exotic investments that we've learned over time. You don't want to run away. You don't want to walk away from. You want to run away from.
Whenever you have this neat package of, you can get all the upside, well, at least a modest return with no downside risk, and there's no cost that I can see, except for you end up with an investment that has tremendous high fees. You have tremendous surrender charges, which is what your commission was, and they're complex. We have someone that works for us full-time analyzing these annuities because they're so complex. I don't want to make fun of the insurance industry, but there's not a huge moat, protecting people to get in. It's not a hard industry to get in. It's not a hard industry to hang a shingle. And I doubt very seriously any of these annuity salesmen understand even an eighth of the complexity of what they're selling.
And I'll give you a great example. I just helped a client of mine unwind one of her annuities. She was getting a 0.01% return on her money.
Wow.
Guaranteed.
Over what period of time, Chris?
Over 20 years.
Over 20 years. Now there's a deal.
Well, here's the irony of it, right? A lot of times what you get pitched is, well, you want to have some hedges against the stock market. So you want to have some of these quote unquote alternative investments that cost an arm and a leg. They're more complex. They're usually less tax efficient. In fact, one of our clients used to build a lot of these products for some of these high-end firms, and he wouldn't put his money there. This just goes to show you how some of these exotic products, how bad some of these exotic products are. But meanwhile, just owning, like you just mentioned, Chris, having a low-cost international index in your portfolio, having a low-cost commodity index in your portfolio, these cheap hedges work better, and they're 100% liquid, meaning you have access to your money, where a lot of these products you don't. That's the worst thing, especially as you're planning for retirement, is not having access to your capital.
So what I'm hearing you saying, Ryan, don't panic because of your fear of the stock market right now, the economy. and take advantage of these wonderful offerings from Wall Street, these special investments in private credit and private equity, right? These, one of the things that I learned early on working for a big institution is my clients weren't the firm's clients. Their clients were big institutional investors who were trying to sell things they couldn't sell to other institutions to my small retail clients. And whenever Wall Street comes out with a special opportunity, you don't want to walk away. You want to run away, especially this private credit and private equity deals that are being offered today.
Well, I think what you're saying, that a special means low return, high fees. That's what I hear.
But they get pitched on high return, right? Because they give you these yields that are really juicy. And, Bob, I think you've said this before, more money's been lost chasing yield at the point of a gun. And the point is, when they're offering 12% or 13%, do you think there's some risk with this investment? Yes, there is.
Yes.
You know what I mean? So there's no free lunch. And we're seeing more and more of this type of investment pitched. And more you have to be more vigilant to stay away from a lot of these exotic investments, because at the end of the day, usually the firm wins and the broker who sold you this investment wins. That's 2/3, but you end up being the loser. And you have to be more careful than ever, because we're seeing more of these charlatans selling more of this BS than we've ever seen before. All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, as of the end of 2024, the average new car price in Europe was $49,000, according to Dunn Insights. The cost of the average vehicle exported from China, only $18,000. China went from 1 million auto exports in 2020 to 6.41 million in 2024. That's a 493% increase. The surge has propelled China to become the world's largest auto exporter, surpassing Japan. Those numbers are like mind-blowing.
I don't know. I saw an advertisement the other day in Europe that a BOGO sale from China. Buy one, get one free. You can get 2 Chinese cars for the price of 1 European car. Yeah, no wonder their sales are surging. But the amazing thing is, none of us have ever seen a car from China. The EV manufacturer, BYD, now the largest exporter in the world, and no one in America has ever seen a car, unless you've been on vacation in Europe or Southeast Asia. They're all over the place.
Yeah, or Latin America.
Yeah, they're all over South America.
Yeah, they're selling everywhere but the U.S. But also, I think it is a big wake-up call for our technology companies, right? You have the same thing going off this DeepSeek. When it comes to AI and these large language models, they're doing it cheaper. They're doing it just as well. Maybe they stole our technology, but at the end of the day, the cat's out of the bag, and now they're our main competitors in a lot of these markets, and they're a lot cheaper. It could be a big problem.
It's going to be a big shock for some of these technology investors who are paying these huge multiples for companies that supposedly have this gigantic moat around their business. Maybe not.
All right, Chris. Since 1964, Berkshire Hathaway has returned over 5.5 million %. A $10,000 investment in 1964 would be worth $550 million today. That's crazy. This compares to a 39,000% return in the S&P 500. Buffett has outperformed the S&P 500 by 140 times. Man, he is the greatest money manager of all time.
And the best part about it is that he did it without owning one bit of Bitcoin. He just did it by buying incredible companies at a great discount. He followed a disciplined strategy, a lot like Payne Capital Management.
Fortunately, I don't think we're going to be turning $10,000 into $550 million anytime soon, but you never know.
Well, you know what, Rye? You got to set those expectations high, and who knows what the future holds.
The best investors of our time, just goes to show, it's not that hard to be a successful investor. You just got to stick to our discipline, and most people do not want to get wealthy slowly.
Well, I think it's also a good reminder too. This is one of the few businesses I think you actually get better at over time, right? Because the more you're on Wall Street, the more you see the cycles, the more you learn from the cycles. As a very famous investor once said, there's no new eras on Wall Street. And I think that's true, right? I mean, stock speculation, the ebbs and flows of bull and bear markets, they don't repeat, but they do rhyme. So I think actually having some experience over the long term and having some scars on your back is a plus. So it's not like football where you peak out in your 20s. So
yeah, it's a low IQ business, right? High IQ investors don't necessarily do as well. It's like you have to have a high EQ, right? You have to have a high emotional intelligence, because it's your emotions that cause you to lose money. not to make money. So it's an interesting study. We've been doing it for 50 years, and I'll tell you what, four most dangerous words are still, it's different this time.
Well, I feel like to be over analytical, right? To be too smart. So you just want to be old and not that smart, and you'll probably be the best investor of all time. There's the recipe.
Yeah, as Charlie Munger always said, tell me where and when I'm going to die, and I won't go there. So keep an eye on me, guys.
Hey, hope you enjoyed episode 203, Payne Points of Wealth. If you like our podcast, you love our podcast, please give us that support. Give us that 5-star rating on iTunes, Spotify. Subscribe to our channel. If this is on YouTube right now, you can like this episode, subscribe to our channel, click that notification bell to be updated every week of all our new content. Your support, spreading the good word, gives us the support to continue to do this podcast. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at BeBullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.